Is this the end of a mid-cap bull run? I do think so, and so let me explain why. So we will analyze this based on the three parameters: technicals, fundamentals, as well as macroeconomics, and see if it is an end of a bull run of the mid-cap segment. So let's begin. First, technically, if we see, 49,000 has been a great resistance for mid-cap index, and it has tried to surpass that mark multiple times, and it has failed. In the last 1 year, the mid-cap segment has run up from 30,000 to almost 50,000, and without any significant correction. And so technically, the market is top heavy and it's not able to cross 49,000 on a decisive way. That's a sign that technically 49,000 is acting as a very good resistance level, and so market needs to cross this 49,000 for the next rally to begin. Second is, let's look at the fundamentals. So from the COVID low of 12,000, we see that mid-cap index has almost quadrupled or more than quadrupled. But earnings have not quadrupled from that level. You can say that COVID low was an aberration. So even if we look at the last 1 year, from 30,000 to 50,000 is almost more than 50% rally. And depending on when you look at it or how you look at it, a 50 to 60% increase in mid-cap index, the earnings has only grown from 20% to 25% range. So clearly, even if you see 3 years rally of mid-cap index, which was from 12,000 to 30,000, and then in the last 1 year, 30,000 to 50,000, that suggests that the mid-cap index is stretched fundamentally on valuations. If we look at the P multiple, mid-cap index P multiple is close to 30, and generally it doesn't get, generally it doesn't get to 30 P multiple, and then it can rally further as well. So this suggests that either there will be a time correction or there will be a price correction or both. Ideally, if there is a both, then the correction will be shallow and it will pass a long time in this range. However, for me to consider that the bull run is not over, the mid-cap index has to cross 50,000, and that looks very difficult. The third and the most important thing is, or most important aspect is macroeconomic. For macroeconomic analysis, we have 4 to 5 things to look at. Good political stability in India, inflation is under control, GDP growth is there, and US there will be a rate cuts followed by rate cuts in India. All this information is known to the market, so most of them might be priced in. You may say that the rate cuts are not priced in, and that's true. But let's say a 25 basis point rate cut comes, and if there is no big surprise like a 50 or a 75 basis point rate cut, then market will not rally, because market has already factored in 1 or 2 rate cuts already, and it moves 6 months ahead of time. So generally, I don't see any new good news in the market that can drive the market forward, that can drive the mid-cap index forward. In the large cap, FIIs are light and they might come back. The Nifty index may not correct that much, or it may hover around or give a time correction. However, the mid-cap index looks top heavy, looks fundamentally stretched, and everything that macroeconomic factors can be factored in looks like it's factored in. So I think this bull run in the mid-cap segment is more or less over, and we would see a long drawn correction in the range of 20 to 25%. So for me, I am taking a stance that I am already 10% in cash, and I would like to increase my cash position to 20 to 25%. This is because I am predominantly a mid-cap investor, and mid-cap looks heavy to me, and so I will be moving out of companies where I don't see, generally I tend to do that only, where I don't see too much of an earnings growth. But even if there is an earnings growth and valuations are stretched, I would like to take some money off the table. Hope it helps everyone who wants to be doing mid cap investing.